thank you for the introduction and thanks for coming out. We have prepared the publication, which has historically just been called Mine, with a subtitle underneath, now for 9 years. And it's the trends which it shows which really start being really insightful. This year we had a subtitle of The Growing Disconnect, which I think just recognises, certainly in my view, where the world is at this stage, which is that we clearly have a world being, the decisions are being made on stock markets out of New York and places like that, which is not where the minerals industry sees its growth. We see our growth in the emerging markets of China, India, etc., etc. They're going along beautifully, frankly. 8% growth. I'll talk more on China undoubtedly as I go through the presentation today. There's no issue with what's going on in Asia. Now, again, we can come back and talk about that, because I know if you read the Western media, you do get lots of concerns about China. I'm sure we will touch on it, and if not, certainly questions at the end. But what's driving the miners should be what's going on in the emerging world, not what's going on in Greece or other parts of Europe, which are bringing us all down. So that's the sort of the first of the growing disconnects. But we'll see as we go through on a number of slides that there's sort of disconnects happening in quite a few places when you get into the detail. So let me just start off with a brief summary of it. There were copies of the document. I seem to think that they all went, because I'm not sure we expected quite as many people, which is fantastic. But more copies can be made available if need be. Basically, what we do is we analyse the top 40 global mining companies by market capitalisation. Now, we've taken 40 because when we've analysed this over many, many years, they basically represent 80% of the industry at just about every level, with the exception of exploration. Okay, so ignoring exploration for a second, and we can come on and maybe talk about that if people want afterwards, these companies are a very good representation of the industry all around the world. So we basically aggregate the results of the 40, so we can look at what's the snapshot of the global industry for the 2011 year, and what's it mean for going forward. So the first bullet point actually shows, again, a great disconnect. Last year was fantastic for profits, 25% increase, yet the market capitalisation of the same companies went down 25%. Doesn't really make sense. There was undoubtedly a huge call from shareholders to get people to stop spending money on capital projects and start returning it to them. We'll look at a graph on that later. A lot of money is still being invested in new projects, but nothing like as much as companies said they were going to invest. Last year, for anyone who heard us do one of these talks last year, the companies had estimated that for 2011 they would spend $120 billion. They only spent $98 billion. We did say at the time we didn't think there was any way they could get up to 120. I think we could easily say as equally now, the 140 which they are estimating for this year, we don't think will be spent by these 40 companies. We think it'll be a lot less. But you just step back for a second and say 120 billion, or around that number, 40 companies, that's $3 billion per company. It's a lot of money going into capital projects still. Key to the future will be supply, and if you do read the document, you'll see this subject comes back time and time again, that 5 years ago we were talking about demand, 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 and saying the future of the industry looks so bright because the demand picture looks so great. Today, we believe the future of the industry looks so bright because supply is going to be so hard to bring to market, and therefore those who are operating will do very well. The next one is quite interesting, because I think that, again, this is something which the Western media seem to totally miss continuously. The high commodity prices we have today, which there's no doubt they are high if you look back at history, but they aren't going anywhere south too quickly, because the marginal cost of production has increased so dramatically that you can't have prices go down to what we used to think of as norms. So gold price $300 an ounce, the whole industry would be closed. Copper, 70 cents, same thing. Not going to happen. So keep on reading in the press that, well, it's elevated commodity prices, they've got a long way to go, etc., etc. They don't have a long way to go down. Some have more than others, undoubtedly, but you need to understand the marginal cost of production. And iron ore is a great example. If we started taking iron ore, if price came down at $80 a tonne for iron ore for any prolonged period of time, 30% of the industry would close. Now, from what I see in China, I go there a week a month, I don't see that they could survive with 30% less iron ore coming to the market, let alone India and other places. It's not going to happen. The last one there, the market doesn't seem to be buying the industry's long-term growth story, which is really about the share price. So we will look at that as we go through it. So let's take a look at the top 40 first of all, to give you some sort of insight to what's involved. What we've looked at there is the graph on the left-hand piece there is the starting number. $1.6 trillion was the market capitalization at the end of 2010. In a 12-month period at the end of 2011, it dropped by 25% and has dropped further since. Of the 40, only 6 increased in value. 2009, which you recall, I guess it was the 2008, 31 December 2008, only 3 companies increased in value that year, but every other year since 2003, there's been at least a dozen have increased in value. So a very bad year from the market cap of these top 40 companies. And if you had invested in all of them equally, you would have lost 25%. And you can see BHP, Vale, Rio Tinto alone account for a lot of that drop. Just 3 companies. And the top 4, so BHP, Vale, Rio and Shenhua, make up 38% of the top 40 by market cap. Down actually from where they have been. And Shenhua was the only one who went up last year. And if you look at the graph, though, you actually see the year before they had a bit of a shocker. The Chinese stock markets had a bit of a shocker that year. So yes, they went up. But if you look at the 2-year number compared to the others, not good. So no one's been spared. One of the other ways where we look at those, obviously to get into the 40, what size is the 40th company? That's the sort of bottom of our listing which we include. And that's the dollar capitalization of the 40th company in each of the last few years. So you can see it's $9 billion this year, which is 18% lower than the year before, which makes sense given we'd lost 25% of the market cap. But it's interesting, it's 3 times higher, more than 3 times higher than in 2008. Now, end of 2008 was obviously after we'd had Lehman Brothers and we'd had a debacle in the world market. So it was a very low ebb in time. But I just ask you to hold on to the fact that you're still 3 times bigger today than you were then to make the 40, because there's another stat coming up which compares today versus then. So if you think back to then, it was doom and gloom, scorched earth scenario, world had ended. So 2.3 mil, so 2.3 bill was what you needed to be in the 40. Here's a very interesting trend, and one which we've obviously been talking about now for a few years, but when we look at the 40 companies and analyze where do they come from, what is it that they hold, we've worked out whether they are an emerging market company or a developed market company. So BHP falls into developed market companies, even though they do obviously have some assets in the emerging markets. But we basically go through each of the 40, categorize them into one of those 2 categories. When we go back to 2003, when we first started the analysis, of the 40, 35 of those 40 companies, or 87.5%, came from developed world. Only 5 of the 40 were from the emerging markets. But if you look at that graph there, the end of 2011, 19 of the 40 now come from those emerging markets. This is an incredible transformation. If you look at the top 4 companies which I just mentioned, we've got BHP, obviously we call that from the developed. You've got Vale, you've got Rio, you've got China Shenhua. 2 of the 4 biggest are from the emerging markets. 2 of the 4 are from the developed. So quite an incredible change in structure of the global industry in a very short period of time. I think we're pretty confident next year it'll be 50-50. So it'll be a tipping point. So really quite incredible, that change. Here's another incredible change. The top 5 diversified companies. So probably all know them, but just for the sake of completeness. BHP